What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Today we're going to go over a topic that has spooked the markets in the past several weeks, and has contributed to the Nasdaq going briefly into correction territory. We'll see what a leading economist from Harvard predicts will happen to the economy, and what areas of the stock market will benefit. Tech stocks especially, such as Tesla, got hit the hardest, down almost 30% from its February highs of $900 a share. That topic is interest rates and inflation worries, especially inflation, which were exacerbated by the Fed press conference last week. In that conference, Jay Powell basically said that the Fed would continue printing money without worrying about rising inflation until unemployment dropped to acceptable levels. Before we go any further, please note that we are not financial advisors, and this video is for entertainment purposes only. Make sure to consult a professional before making any investment decision. This video is supported by our channel members, who get access to all of our non-time sensitive videos one day in advance. On March 17th, Federal Reserve Chair Jerome Powell gave a press conference following the Federal Open Market Committee meeting last week. In the press conference, among other things, he said that the Fed will continue its Treasury bond purchase programs and add to its balance sheet. This essentially means that the Fed will continue to print money. He said that the Fed will possibly cause significant short-term inflation, but will not stop quantitative easing before unemployment numbers and the economy recover significantly from where they are now. This raised fears by many economists that we will see significant inflation in the coming years, to the extent that it will be very difficult for the Fed and the economy to deal with. Larry Summers, a Harvard economics professor and former US Treasury Secretary, recently did an interview with Bloomberg making a bold prediction of what the Fed's current policy will mean for the US economy. We combed through the interview for the most important points, and in this video, we'll go over the main elements of Larry Summers' prediction. He first says that he thinks we are now seeing the least responsible macroeconomic policy of the last 40 years. He then goes into 3 different scenarios for the US economy. We'll go through exactly what his main points were, then talk about what each scenario would mean for stocks.
David, I'm much more concerned. Markets have had their biggest increase in the 10-year in a century, with only one exception, showing that they've got a real concern. The fiscal policy outlook has dimmed from where it was as the full stimulus that was contemplated then has passed. People have declared that it's a new era in ways that suggest that large fiscal policy will continue for a long time to come. The COVID recovery has accelerated, which is a very good thing, but means more demand pressure. And the Fed has stuck to its guns on no rate hikes for years and years, and continuing to grow its balance sheet. So it seems to me that what was kindling is now igniting. And I am much more worried that we'll have either inflation or we will have a pretty dramatic fiscal monetary collision.
Are we mishandling macroeconomic policy right now in the United States?
I think this is the least responsible macroeconomic policies we've had in the last 40 years. I think fundamentally it's driven by intransigence on the Democratic left and intransigence and completely unreasonable behavior in the whole of the Republican Party that's driven us to the kind of political deals that we're seeing, and they're understandable. And I understand why reasonable people, given the tragic choices they have, might make these kinds of macroeconomic choices. But I think we are running enormous risks.
His main point is that because of the pandemic, the fiscal and monetary policy of the past year have done the right thing to fight unemployment and give aid to citizens. However, as an inevitable byproduct, this carries huge risks to the economy. By injecting capital into the markets and having helicopter money, the Fed has increased demand pressure without increasing supply. By printing trillions of dollars literally out of thin air, the likes of which have never been seen before even after 2008, the money supply has been artificially inflated. Moreover, after Jay Powell's recent press conference, it seems that the Fed will continue to print money. Here's what he says the ramifications may be.
I would put the risks this way, David. I think there's about a 1/3 chance that inflation will significantly accelerate over the next several years and will be in a stagflationary situation, like the one that materialized between 1966 and 1969, where inflation went from the range of 1s to the range of 6s. I think there's a 1/3 chance that we won't see inflation, but that the reason we won't see it is that the Fed hits the brakes hard, markets get very unstable, the economy skids downwards close to recession. And I think there's about a 1/3 chance that the Fed and the Treasury will get what they're hoping for, and we'll get rapid growth, which will moderate in a non-inflationary way. But there are more risks in this moment that macroeconomic policy itself will cause grave consequences than I can remember. There have been terribly serious moments in the past, but then macroeconomic policy was trying to stabilize things. Now, there's the real risk that macroeconomic policy will be very much destabilizing things.
So there are three equally likely possibilities according to Larry Summers. The first one is that we have stagflation, where there is high inflation despite little economic growth. This would be the result of the Fed increasing the money supply as they are doing right now, while the economy does not keep up, causing self-inflicted inflation. In this scenario, we would see prices rise across the board, from sneakers to software to cars and everything in between. If this happens, there are two characteristics of companies that would benefit: companies that sell commodities tied with a wide cross-section of the economy, such as oil, and companies that are highly leveraged with long-term debt. Oil in particular is highly hedged to inflation, because oil is so closely tied to transportation, which is itself an integral part of almost all sectors of the economy. As companies in all sectors are able to raise prices due to inflation, they will be able to pay higher nominal prices for fuel, which will in turn increase the earnings of oil companies. Number two, companies with large amounts of debt will benefit from stagflation. Debt is denominated in nominal amounts. In other words, debt is usually not pegged to inflation. If a company takes out $100 million of debt at a 7% interest rate, but then inflation rises to 10% inflation, they're still only paying 7% on that debt. Meanwhile, if the prices of their goods sold increases with inflation, suddenly their interest payments become much less than they used to be when considering their inflation-boosted revenue. An example of a company that fits both of these criteria is ExxonMobil. The second scenario is one in which the Fed raises interest rates and causes a recession. In this scenario, things would be tough for the economy in general, but defensive names like Coca-Cola and Procter & Gamble, companies with low debt, stable dividends, and resilient cash flows, are most likely to outperform. In 2008, the entire market sold off due to the housing market decline and subsequent financial crisis. During that time, the S&P suffered a more than 55% decline from peak to trough. However, Coca-Cola only declined about 30% during the crisis. These defensive stocks are often seen as safe havens for investors when other companies are going bankrupt, because no matter what happens to the economy, people will still buy $1 Coke from Coca-Cola, and they'll still buy paper towels from Procter & Gamble. Also, because their earnings are durable, their dividends are dependable. Some people even refer to these names as bond proxies, because their dividends are almost like the yields on bonds, except that they won't get crushed by inflation. However, in a true recession, it's not going to be pretty for any stock. These are just the stocks that will be the most resilient in this scenario. The third and final scenario is one in which the Fed gets what it's hoping for, which is that economic growth overcomes the damage that the pandemic has done to the economy, and we won't have inflation. In this scenario, the typical bull market winners will continue to outperform, in particular tech companies. The companies with high growth and high multiples as a result of expected future earnings will be more likely to hit their expectations in this scenario, causing them to take market share and outperform. These companies will benefit from owning disruptive technologies that allow them to leverage existing markets, take market share, and benefit from a strong consumer. If the economy is doing well and wages are up, for example, a company like Tesla will be more likely to be able to hit its targets for sales. So to summarize, Larry Summers thinks that there are three possibilities for what the ramifications of the Fed's seemingly infinite money printing will be. In the first scenario, the Fed will keep printing money to evade the economic disaster brought about by the pandemic. In this scenario, economic growth will be muted while inflation takes hold, leading to stagflation. In this scenario, companies that produce commodities or other products linked to the value of money will benefit, along with companies with high debt. An example of such a company is ExxonMobil. In the second scenario, the Fed rolls back quantitative easing and raises interest rates, leading to a recession. In this scenario, the classic defensive stocks will be more likely to outperform, such as Coca-Cola. In the third scenario, economic growth is so rapid that the economy recovers from the pandemic, in which case high growth and technology stocks will benefit. Professional money managers may consider the possibility of all three of these scenarios and prepare for each of them. Alright guys, that wraps it up for this video. If you liked the content, make sure to hit that like button and subscribe for future content. Let us know what you think of Larry Summers' prediction in the comments section below. And finally, make sure to follow us on Instagram and TikTok. In the meantime, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.